Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show where we're going to talk about global implications on different things going forward, especially when we look at some of the most recent impacts from what happened in Russia, like with the Wagners, what is happening with some other wildfires in terms of some of the things that shut down the Bosphorus Strait or the Turkish Strait. But when we look at what's happening globally, we're going to have our normal 5 segments, but we want to look at social mobility because that's starting to come back to the forefront. And for those that have been following us, we wrote a whole research paper on how social mobility has been massively impacted for a very long period of time. And that social mobility, or that lack of social mobility and economic growth, is really the crux of some of the problems that are happening and how people feel disenfranchised or angry, but they're not really sure why. And I think you're seeing that more and more, and they're lashing out and they're grabbing onto different things, whether it's environmentalism, whether it's anti-Fed or anti-something else or anti-dollar, but they're trying to find the solution, but it comes down to the lack of social mobility, the lack of economic growth, no matter how hard you work. And that's where we've talked about inflation, and that's where inflation has been impacting us for so long. They'll claim it was at 1.8, 2%. It was much higher. And for anybody that was paying for school or education or childcare or food, you're seeing what they're saying on television. It's like, oh, it's 1.8%. But you're like, well, that's not what I was paying in the store. That's not what I was paying for childcare. That's not, and when you actually broke it down in terms of healthcare and everything else, it was closer to 4 to 5%. Now, COVID essentially ripped the Band-Aid off as every government and central bank flooded the market with liquidity, and that's again creating that buildup. And now we've opened Pandora's box, and here we are, and it's very difficult to get that back in, but we'll talk about that in segment 1. Then we want to talk in segment 2 about Fed rate hikes and the impacts, and how long does it take for those impacts to come through? What is going to be the ramification? Who's going to benefit, not benefit from it? Hard assets will benefit. That's why C6 is investing in that, and that's a key component of some of our investment thesis. Then we're going to look at leading indicators and the service front. So for those that have been watching us, we've been saying that on this PMI level, so looking at PMIs, they break it down into service and manufacturing. We were saying that manufacturing was going to pick up a bit, still be contracting, but accelerate a touch. But we were going to see services actually fall, and that was going to be the lion's share of the issues, and it's starting to play out. And we want to go through, does it continue and how much? Then we're going to look into Europe, and the service sector is now fully in contraction. They're already, as we've been saying, in a recession, and we want to go through how bad some of the data was, because it was a bit ugly when you look at, on a GDP level, how does that impact and really filter down through the economy? And then in the last segment, we want to touch on, does China enter a recession? And the short answer is no. We've been saying that China was going to be under a lot of pressure. There's going to be a lot of stress. But we've made comments multiple times through a plethora of shows that's saying, like, look, things are going to be tough, but not going to be in a recession. It's just the market is expecting 4.5 to 5% GDP growth. And our point is, they're going to be lucky to hit 1%, but it's not going to be contracting. And that's what we want to look at, some of the key points and what some of those headwinds will be when it comes to underlying growth. So as we build off of that Chinese comment, and China comment, and how you kind of build this all in, it's interesting to look at that social elevator. So first, we're going to start with the chart on the right. When you look at the average number of generations needed for children from low-income families to reach the average income level. And you get an idea of the problems it takes and the difficulty it takes to reach those levels. And it's just because you have to have families that will sacrifice so that those children will be able to go to a better school or school at all, because some people may not have even graduated from elementary school. let alone high school or college. And it takes time to walk up that ladder. And there's social constructs that can make it very difficult to breach, whether it's a caste system that may not really exist in cities, but still are prevalent to a degree outside the cities in the rural areas. Then you have a bit of tribalism when you look at areas within Africa, parts of the Middle East, where you still have that tribal separation and impact. And these are things that create difficulty in moving up that social ladder and again, on that economic basis. One of the things that we've done a lot of research on and we've talked about on these shows in our research, it comes down to the inability of people to move up the economic ladder. If you've always told, work hard, you'll be rewarded. Well, those rewards were getting harder and harder to see and to achieve. And there wasn't a natural path. And that corporate ladder or moving up the corporate ladder became very difficult, if not stagnating. And that's where that frustration starts to pick in. It's like, I went to school, I got good grades, I got a good job, and now I still am struggling. I still don't have a lot in savings. I still can't live the American dream or the dream of that location of, having a vacation, having a nicer home, or, one or two cars. But yet you're working for it, but it's just outside of your grasp. And there's a lot of things that have been impacting that, whether it's inflation that was much higher versus what was actually announced. And that inflation, and we've talked about it again, it is a tax on the middle class and the poor. And that's a big piece of the problem, because when you look at where you started to get the social anger and this this diverse backdrop kind of moving into its own corners, and people grabbing onto the left or to the right or to some other means of this is the reason why this is happening. It's like, well, it's not. It could be a piece of it with very good reason, but there's this anger in this, and people and politicians are focusing in on, this is the reason why, and if we eliminate this, everyone will be happy. And it's like, but that's not true. And that's why we talk about a basket approach, because we have to address all of these issues, whether it's environmental, whether it's the left agenda versus the right agenda. It's like, well, we have to figure out coming to the middle to make sure that everybody's moving up. And a lot of this happens from reshifting the business cycle. Typically, especially in the US, a business cycle is a good thing when you have down markets. And when they announced, classically in 2019 that we've ended the business cycle because we'll never have a down cycle. It's like, down cycles are good. You're resetting the system. You're going to purge the companies that are stagnant. You're then going to move some of that capital that was in stagnant businesses in a Chapter 7 or a Chapter 11. Then you're going to move them into a new business that may be growing. And you also are forced to do due diligence. Is this company going to generate cash? Is it not going to generate cash? What is the feasibility of this market? Instead, you had just money getting thrown around and debt getting thrown around, and you created this anchor with leverage. And we talk about the US, but this is played out all around the world. And now you have to have this deleveraging moment, because the business cycle replaced the uprisings. Without the natural business cycle where people who feel like they're being left behind, there's a down move, then all of a sudden assets get a bit cheaper. Maybe if they were good with their savings, they could afford a home. They could take advantage of some of these things. They could if they get laid off, they have some savings that they can go out and create something new. And then again, create this opportunity, and this reset, this natural purge and recycle is why the U.S. bankruptcy system is so robust. It's because it's okay to go bankrupt, because if it's a good idea, you'll get Chapter 11 money. And for someone who's an investor, it's like, well, maybe I see a value there, and I'm going to be able to get in at a discount and provide growth and my expertise, bringing them to the next level. And by staying in front of that and stagnating it, you're essentially putting this barrier, and people will break through it, whether it's natural business cycles or with weapons. And that's something that is important to look at. But then when you look at China and how they feel about the rest of the world, you get an idea. And I don't buy into some of this, because it's always going to be pivoted based on who did you ask, in what regions did you ask. And the U.S. obviously is at the very unfavorable 37.4, but I don't see that in the same way. And again, it could be the regions that I'm dealing with. There's always this angst of, well, the U.S. is doing this, but there's also, there's that the news that's out there versus what isn't out there. And I think there's, the CCP and the news want to show something, but how do people really feel beneath it? Japan, that's a long history between Japanese and Chinese, and that's some or many there. Remember, the U.S. was in China helping to defend and fight against the Japanese. We did fight shoulder to shoulder at a time. India and China have been at odds for as long as the Silk Road. That's not something that goes away. And again, that's some of that tribalism. That's some of that inherent ancestry that bleeds through the front. South Korea is something similar. But then when you look at Russia, and this is what they're trying to pivot in terms of how people view Russia. But then when you speak to people on the ground, as I'm lucky enough to, what they're saying versus that is vastly different. Just like what they're saying with the U.S. is vastly different. Now, I have a smaller sample set as well. I'm speaking to specific provinces that may be more, democratically leaning based on how the Civil War took place and how a lot of the more democratic views were pushed south and obviously ended up in Taiwan. But Russia's a very unique one because there's been a lot of consistency in terms of how they feel about Russia. And then you have what happened with the Wagner Group when you had the plane that was shot down, which again is going to create a potential more risk within. I'm sure everyone saw video of Putin rushing to get to the Kremlin because I think there's a concern of, is this going to create problems internally within Russia? China backed Russia aggressively, and now they're starting to distance themselves. And I think this is going to be an interesting one to watch to see how this plays out over the longer term. And the reason why it's going to be interesting is because the central bank policies. We've had so much easy money. We've had so much the zero interest rate policy, this liquidity everywhere. Well, that has to end at some point, whether the central banks allow it to happen or the market forces it to happen. It always comes to pass. And this is where the market, and that's why we wrote an article talking about how, yields are crashing the Fed party, and now they're reactive. Now, China did cut some of their rates, but again, they cut those shorter term, but not the longer term. And that's something that we want to go through in segment 5. But here you can see that there's going to be a difficulty in terms of trying to eradicate some of this leverage. And I think the debt service ratio for companies and households is very interesting because the U.S. has benefited from lower rates, the strong dollar. So even though the debt levels have increased, the service cost is fairly low. Where when you look at China, that's not the case. And that's why I talk so much about the 10-year. And some will say, the 10-year is going to cripple the U.S. markets. And I agree, it'll impact the U.S. markets. But the 10-year sets the stage for bonds, loans, mortgages, around the world. So if the 10-year in the U.S. is going up, well, what does that do to a country like China or Korea or India that use that as a base to set their levels? Well, that's going to push their rates up above what we are, especially when you have weakness in some of the local currencies like the yuan and the yuan. And that's the important piece when you look at service ratios and the different levels and why we think that China has longer term stagnation. But one of the key things that we've been talking about incessantly is that the U.S., then globally speaking, we're in a period of stagnation. It's not like we're going to have this massive, recession that takes the world down 10%. It's that we're going to bump along at this negative 0.5 and negative 1% for a lot longer than what the market expects because of the deleveraging that has to happen in order to make the next leap forward possible. And that's where you're going to have this, let's call it a lost decade, if you will, and how that's going to impact not only lending and borrowing, which is why we're seeing this tightening up, the shortage in liquidity. But everyone likes to look at M1, M2 and be like, oh, look, it's negative, therefore recession. It's like, but how much is still out there sloshing around? Like we just got the RRP numbers come out for the US, and you still have over 1.7 trillion sloshing around in a repo. Like this is a problem that is going to have to, again, get unwound. And the PBOC in China laid it out very clearly in 2017, and then again in 2019. More in 2019, they got stricter on it, that credit impulses have to come down. And they have to go negative. And you're seeing the impacts. Now, I don't think there's enough economic pressure at the moment to take it negative, but they're going to have to recognize much slower growth than I think they're used to, or what is politically, favorable if you look at the Chinese markets. Now, this just puts into perspective some of the debt buildup and total debt to non-financial sector as a share of GDP. It's come down in the US and Eurozone, but it's continued to climb in China. And that's something that we see adjusting. And that's where we do see China deleveraging and coming closer to where the US and Eurozone sit. Now, the problem that's going to come through is this is a debt to GDP ratio. So when you look at GDP, well, if GDP falls, technically you're going to see that pivot and get worse, which is what we're seeing a bit more in China, as you've had some deleveraging from a consumer, and we'll talk about this in the next segment, and how in the U.S. a lot of companies have been able to kind of kick that debt wall, or that I should say the maturity wall, a little bit further out, obviously at higher rates, but not to the same degree that we've seen in some other areas. Now, this also looks at loans that have been given out by China, because a lot of people like to talk about how China is insulated, and it's like, well, they're not, and they were the biggest lenders to some questionable counterparts. When you look at frontier markets, emerging markets, and that's what we've seen continuously from every place from Pakistan to Malaysia. And that's where we get some of these impacts that I don't think are appreciated in the market, because can Pakistan pay back all this money? Can Egypt, can Mongolia, can Malaysia? And at what point do you get write-downs that are going to accelerate? And then is there enough collateral to absorb the losses that are going to be taken in non-traditional locations, which is going to be a problem going forward? Now, China is struggling in terms of exposure to, and China is struggling, but also countries that rely on China. And Germany has doubled down on that over the years. And that's where they're getting hit the hardest, which is why we see the Europe and the Eurozone in a much tougher position than others, because China is slowing. I think that's a very big problem that is not appreciated to the same degree, while China continues to invest and lock in, and solidify some of their commodity exports and commodity imports. And this was a huge piece of the BRI, or the Belt and Road Initiative, initially the One Belt, One Road, that was so pivotal of trying to bring these imports in and creating Made in China 2025, and which has been extended to 2035, and trying to create this, but at what cost? How much money was given? What rates was it given at? Is it getting paid back? And that's where we see some of these problems that are going to have to be cleared out within the Chinese economy. Then when we look at the short emerging markets, long US dollar, we've been saying from the beginning, the dollar is getting a reprieve because it's still a source of safety. It's still a way to mitigate inflation. It's still a way to buy dollars, buy US debt, because it's trading at a price that is now, the 10-year at 4.25. You're like, all right, that seems pretty good. That's where you're starting to see that carry trade, which is putting some of that upside pressure into the dollar and helping to cap kind of where we see the 10-year. We do think that 10-year creeps higher, but it's going to be more of a creep and less of this explosion, which we expect to see in Japan, which we'll talk about in the last segment. Now, margin debt continues to fall in the U.S. as it is elsewhere because margin's expensive. But you're starting to see some of this repricing where emerging market stock prices are coming down because you're like, well, there's risk in emerging markets as that 10-year goes up, as bonds get more expensive and equities struggle, and you get a deleveraging, and that margin debt is something that I think is indicative of kind of where that pressure is, and people are stepping out from options, stepping out from borrowing, because I think you're starting to see that. And that'll reduce some of the liquidity that's currently in not only the U.S. stock market, but also other markets that saw a similar liquidity push from the retail sector. Now, when we look at some of the things that have happened on a geopolitical standpoint, one of the things that I talked about when I was at Bloomberg was don't sleep on utilities, because utilities, I found when I did a lot on IoT, was that utilities were the least protected from cyber attacks, from these impacts. And it's funny, not funny. We've actually found that healthcare has a sizable gap in it. And that has been, when you look at healthcare and you look at utilities, that has seen a sizable increase. Government, military, finance, banking, I would assume those to be higher, but I think the ones that people are sleeping on is utilities and healthcare. Now, obviously, transportation, as traffic lights become more synced up with pressure sensors and counters and are linked to computers, why couldn't you just make every light at an intersection go green and watch them crash into each other? There's ways to do that. And that's why we have to get smart about what those cyber attacks will look like, especially when you see, where I think Sweden is supposed to be voted into NATO over the next month. What does that mean for, is Russia going to launch a renewed round of attacks? Are they going to try to go on the offensive following the Wagner attack and taking down the management, or I should say the commanders of the Wagner group? This is going to be in a pivotal piece in terms of what are these reactions going to be, and as we've seen with the increase in attacks. Now, I thought this was a funny chart because everybody talks about how in the U.S. and Europe we have to reduce coal consumption, which we are, but for everything we're reducing, China's doing more of. So when you look at global consumption, it stopped going up, but it's not coming down. And it's just because, again, this is that greenwashing, some of that movement where it's going from the U.S. into China. But, at what point does that start to reach kind of the precipice? And we think it's here, but this is what we've said from the very beginning when we looked at coal consumption, when we saw ESG really starting to take hold, which is converted into more of a sustainability view and a more holistic view, is that, coal, it's unlikely we're going to see the drop. We have to be realistic and say, okay, well, regionally speaking, it makes sense to have coal, and there's enough, technology out there to decarbonize it and to make it greener. And we should be realistic about trying to deploy that in a meaningful way, as well as, make it cheaper for LNG, the stranded gas, and move that into the market, because converting from coal to natural gas is a good way to make a very direct near-term impact, especially flare capture, something that we're working on, which I think is another opportunity. So that's what we have for you in this grouping. In the next segment, we're going to go deeper into the U.S. and some of the things that are happening with the Fed and how those rates are going to impact us.